students. So this is my website. Today's video class, the subject is Financial Accounting 2. It is for becoming second semester students. In that, accounts for non-profit organizations. This is the topic what I want to teach in this video lesson. So let me start this video lesson. So through this video lesson, we are going to learn non-profit organizations introduction part, features of non-profit organizations. What are the features existing non-profit organizations? What is the difference between profit and non-profit organizations? That also we will discuss. What are the accounts are to be prepared? How many accounts are to be prepared through this in non-profit organizations? That is also to be known. Differences between receipts and payments accounts and income and expenditure accounts. So what is the difference between let us say what is receipts and payments account, that we will discuss, and what is income and expenditure account, that is we discuss. But what are the difference between these two accounts, that is also we are going to discuss through this video lesson. Special terms, what are the special terms are used in this non-profit organizations, that is also we will discuss. Again, last one, how do we prepare find accounts in this non-profit organizations, that we will discuss in detail one by one. So let us start this introduction part through this video lesson. So non-profit organizations introductory part. So one thing you have to remind, there are two types of organizations, that is profit seeking institutions and non-profit seeking institutions. These are the two types of organizations. So we have one is profit seeking institutions, another one is non-profit. So what is profit seeking institutions and what is non-profit seeking institutions, that we discuss in detail. So the institutions or organizations are established based on the profit motto, that is profit seeking institutions. So where profit is not the motto of the organization, that means the service motto of the organizations, that is non-profit seeking institutions, or we can say non-trading concerns or non-trading organizations. So earning profit is the motto of profit seeking institutions. Earning profit, that is the objective of that institutions. So that is a profit seeking institutions or trading institutions or trading organizations, what we say. So the other side, so let us say examples to this: sole trading concerns, this is profit seeking institutions or profit seeking organizations. Partnership firm, that is also profit earning institutions or profit earning organizations. Joint stock companies, so what are the form of business organizations we have? Those form of business organizations are to be known as profit seeking institutions. Profit seeking institutions. So where service motto is the main objective, that is non-profit seeking institutions. Object to serve the people rather than to earn a profit, that is known as non-profit seeking institutions. So what are the organization at the end of the year? All the accounts are to be prepared. So based on that we will discuss. So non-profit organizations, let us see examples. Which type of organizations are to be known as non-profit organizations? So in that In this category comes under education institutions, clubs, libraries, charitable institutions, literary and cultural societies, hospitals, public utility undertakings. These are the institutions are to be known as non-profit organizations. Education institutions, hospitals, clubs, libraries, charitable institutions, literary and cultural societies, and public utility undertakings. These are the institutions are to be known. These are the organizations are to be known as non-profit organizations. So whatever it is, in profit organizations, at the end of the year, you have to prepare final accounts. At the end of the year, you have to know what is the profit, what is the loss. Based on that, some of the organizations or whatever the organizations are to be paid tax to the government and to the shareholders, and the results are to be disclosed to shareholders. So like that, and at the same time, investors also to know the profit, what is the financial position, that is also to be known by this, to be known by the this file accounts, then whatever we are preparing at the end of the year. Okay, so whatever the type of organization, it may be profit seeking institutions or non-profit seeking institutions. So at the end of the year, all types of institutions are to be prepared this type of accounts, final accounts, what we say generally final accounts. So in this case, that means non-profit seeking institutions are to be prepared at the end of the year. Receipts and payments account, income and expenditure account, and the last one, balance sheet. These are the receipts and payments account and income and expenditure account. These are the accounts are to be prepared at the end of the year in non-profit organizations. And one more, balance sheet is also to be prepared to know the financial position. These are the three items. So we can say first two are accounts, last one is statement. These three are to be prepared at the end of the year, where in non-profit organizations. So let us see what is a receipts and payments account, and what is income and expenditure account, what is balance sheet. So like that we will see one by one. So receipts and payments account. So receipts and payments account consists real accounts in nature. We know what is real accounts. Debit what comes in, credit what goes out. Debit what comes in, credit what goes out. So that's why whatever the property, whatever the assets are coming inside to the organization, all are to be debited. Whatever the assets and whatever the properties are to be going outside from the organization, that is to be credited according to the real accounts principles. The same is to be followed here also. So that's why it consists cash account in nature. So cash transactions of a given period is classified from showing receipts and payments under distinct headings. All the receipts by check or cash are recorded on the debit side. So whatever the receipts are to be received by the organization, received by the non-profit organization, are to be recorded on the debit side. So we can say one thing, all the receipts are to be recorded on debit side, and all the payments are to be recorded on credit side. So let us see, it is clear, all the receipts are to be recorded on debit side, all the payments are recorded on credit side. So where we recorded in cash account also, in cash book also, the same is followed here also, because it is also same. From there, from cash book we prepare ledger balances, but here need not to prepare any balances, but it is receipts and payments account. Okay, so receipts and payments account starts with opening balance. Receipts and payments account starts with opening balance and it closed with closing balance. Closed with closing balance. Opening balance may be cash balance, maybe bank balance, or both the balance will be there. Both the balances will be there. The same at the closing date also, at the closing time also, cash balance will be there, bank balance will be there, or both the balances will be there. So that is the opening and closing balances. Opening balances is to be recorded on debit side. Closing balance is to be recorded on credit side. All the receipts are to be recorded on debit side. All the payments are recorded on credit side. So one thing we can say that is all the payments, all the receipts more than the payments. All the receipts more than the payments. So without receiving amount we can't pay. So that's why all the receipts are recorded on debit side is more than the payments. That is credit balance. So that's why closing balance is recorded on credit side. That may be cash balance, that may be bank balance. Sometimes maybe both of the balances may be there. Okay. So one thing we have to know the revenue items and capital items. So whenever we are writing receipts and payments, we need not to worry about capital and the revenue items. If it is paid, just you write on payment side. If it is received, you write on debit side. That is the thing. But you need not worry about capital and revenue items. So what is capital and what is revenue items? That we have to get clear idea about these two items. So revenue item, whatever the repetitive in nature of the transaction, that is known as revenue item. Repetitive in nature. The transaction is occurred repeatedly in the year, during the year many times, that is revenue item. The capital item, this is non-repetitive in nature. So the transaction is done maybe once or twice, or sometimes none of the times also it is possible. So that's why whenever we are writing transactions in receipts and payments account, it may be capital item, it may be revenue item. There is no difference between capital and revenue items. If we are receiving amount, then you record on debit side. When we are paying, you record on payment side. So that is the thing. Okay. Here you see one more thing. What is the thing? The transaction maybe belongs to current year, preceding year, or succeeding year. Whatever the year, there is no time bound. It is payment, just you write on payment side. If it is receipt, just record on receipt side. So that is the thing. So about the time also we have to take any implications. Okay. All the okay. Right. So next thing. It does not reveal the actual income or expenditure of the period it covers. This account helps to prepare an income and expenditure account. Okay. So this is the thing. Whenever we are preparing receipts and payments account, so all the receipts are to be recorded on debit side. All the payments are recorded on credit side. That is the thing. Receipts and the payments. So receipts are recorded on debit side. Payments are recorded on credit side. the receipts and the payments may be preceding year, maybe current year, maybe current year, or maybe succeeding year. And one more thing, the transaction may be capital item or maybe a revenue item, whatever it is. So that is the thing. So at the end of the year, we may balance receipts and the payments account. Then we may get balance as cash balance, as bank balance, or both the balances may come. So that is the thing. Whenever we are preparing receipts and payments account. Alright. So next one, income and expenditure account. Income and expenditure account. So this income and expenditure account consists the nature of nominal accounts. Nominal accounts. So what is the principle of nominal accounts? So debit all the expenses and losses, credit all the incomes and gains. That is the principle of nominal accounts. So where in trading organizations, trading account and profit and loss account is prepared. Okay, so here instead of profit and loss account, we are preparing income and expenditure account. Okay. Alright, so one thing you have to remind, non-profit organizations. This account serves exactly the purpose for which profit and loss account serves in a trading concerns. So just we discussed what is it. So the next one, in other words, income and expenditure account resembles profit and loss account in all aspects. All incomes and gains are shown on credit side. All incomes and gains. So just now we discussed the principle of nominal accounts. All the incomes and gains are shown on the credit side, and all expenses and losses are to be shown on debit side. So just now we discussed about the principle. The same principle is applied here also. Income and expenditure account. So whatever the expenses and losses are there, and they are to be debited to profit and income and expenditure account. Incomes and gains are to be recorded on credit side. So here one thing you have to remind. So earlier we prepared receipts and payments account. Earlier we prepared receipts and payments account. Now we are going to know income and expenditure account. So in this, some principles are to be followed. Here all the revenue items are to be recorded. All the revenue items. So what is revenue items? Whatever the repetitive in nature, that is to be recorded here. Capital items are not to be recorded here. And one more thing, time. So in earlier case, that is receipts and payments account, we discussed as the transaction may belongs to preceding year, current year, or succeeding year. Whatever the year, if the transaction is done, then you have to record in receipts and payments account. But whereas in income and expenditure account, you have to think whether the transaction belongs to the current year or not. If the transaction belongs to a preceding year or succeeding year, not to be recorded here. The transaction belongs to preceding year and succeeding year is not to be recorded in this account. So that is the thing you have to remind. And sometimes the adjustments are to be taken into consideration here. What are the adjustments? So whatever, sometimes some amounts are to be paid, some amounts are to be received. So whatever it is, the adjustments are to be recorded, or adjustments are to be considered in this case. Whereas in the earlier case, adjustments are not to be considered. Okay, so that is the thing. So here there is no opening balance, there is no closing balance, but ultimately we get the balance like surplus or deficit, surplus and deficit. So in case when we get surplus, so when the credit balance is more and the debit balance is less, then we get surplus. When debit balance is more and the credit balance is less, then we get deficit. Okay, so on debit side what we write? Expenses and losses. And credit side what we write? All incomes and gains. If incomes and gains is more, then we get surplus. If expenses and losses is more, we get deficit. So that is the thing. Okay, so this, whatever it is, the surplus or deficit is to be transferred to capital fund. Transferred to capital fund. If surplus is there, it is to be added to capital fund. If deficit is there, from capital fund it is to be deducted. It is to be deducted. So these are the items are to be considered while preparing income and expenditure account. While preparing income and expenditure account. And one more thing. So let us know the differences between these two. So we may consider some points in one account, we may not consider some points in another account. So let us see what are the differences between these two. So while preparing receipts and payments account, one points are to be reminded, one points are to be ignored. But whereas in income and expenditure account preparing, one point is to be considered, another point is to be ignored. So let us see what are the points are to be considered, what are the points are not to be considered. So what is the difference between these two, that we have to know. So then only we can know while preparing these income and expenditure account and the receipts and payments account, we can get clear cut idea. So that's why. So let us see these differences between these two accounts. So first receipts and the payments account, and the next income and expenditure account. So you see it is a summarized statement of cash receipts and the payments during a particular period. So during a particular period, what are the receipts we have received, what are the payments we have been paid, those items are to be recorded in that statement, that is receipts and payments account. Okay, during that period, of course recording receipts and the payments may belongs to the preceding year or succeeding year, but particular period, during that period, that may be received. So that's why that is the statement to be known, receipts and the payments. So where you see income and expenditure account, it is a substitute of profit and loss account in non-trading concerns. So this is a statement consisting receipts and payments. This is an account consisting income and expenditure, incomes and gains, and expenditure and losses. Expenditure and losses are to be recorded on debit side. Incomes and gains are to be recorded on credit side. So in case of receipts and payments, all the receipts are recorded on debit side, all the payments are recorded on credit side. So you see, next point, it commences with the opening balance. So you see, opening balance may be there, closing balance is must, or maybe they may not be there. So, but there should be opening balance, there should be closing balance. A balance, closing and opening balance may be cash balance, maybe bank balance, or maybe both the balances. So it started with opening balance and ended with closing balance. Okay, where in case of income and expenditure, there is no opening balance and closing balances, but instead of closing balance we get a surplus or debt sheet we get. Okay, receipts are entered on the debit side and the payments are recorded on credit side. Yes, that is already known to us. All the receipts are recorded on debit side, all the payments are recorded on credit side. So whereas in income and expenditure account, incomes and gains are recorded on credit side, expenses and losses recorded on the debit side. Okay, these are the differences between these two. And the next one, it makes no distinction between capital and revenue, receipts and payments. Okay, so whenever we are recording receipts and payments, there is no distinction between capital and revenue items. So if it is a receipt, just you record on debit side. If it is payment, you record on payment side. That's it. When we are preparing receipts and payments account. In case of income and expenditure account, only revenue items are to be considered. Revenue items are to be recorded. The capital items are not to be recorded here. Only revenue items are to be considered while preparing income and expenditure account. So that's it. So you see, next one more difference. So that is, it does not include outstanding and prepaid expenses. Outstanding and prepaid expenses. Yes. So prepaid and outstanding expenses, or you can say receivable and payable items are not to be considered in preparing receipts and payments account. But whereas in income and expenditure account, it is to be considered. So all the receivables and all the payables for a particular period, it is to be considered. It is to be considered. Okay. Next you see, next difference. This account belongs to the category of real accounts. Yes. So receipts and payments account consisting the nature of real accounts in nature. That's why all the items, debit what comes in, credit what goes out. So the principle is to be followed while preparing receipts and payments account. This account belongs to the category of nominal accounts. So nominal accounts principle, we know, that is debit all the expenses and losses, credit all the incomes and gains. So the same principle is to be followed while preparing this income and expenditure account. So next to see the difference between two sides to represent the balance of cash at the end. So the closing result of receipts and payments account would be balance, closing balance. The closing balance may be cash balance, may be bank balance, sometimes both may be there. So where difference between two sides mean either excess of income over expenditure or vice versa. That what we say surplus or debt sheet. If incomes and gains more than the expenditure and losses, then we get surplus. If income and expenditure is more, if expenditure and losses is more than the income and gains, then we get debt sheet. So that is the difference between these two. So it includes all items relating to current year preceding year and succeeding year. So time is no bar while preparing receipts and payments account. Whereas income and expenditure account, only current year items are to be considered. Preceding items and the succeeding year items are not to be considered while preparing income and expenditure account. So that is a thing. Okay, it does not include items like depreciation and bad debts. So whatever the items are to be recorded on debit side of profit and loss account, that is in trading concern, those items are not to be considered here, because all the adjustable items, what we say, adjustable items are not to be considered. Adjustable items are not to be considered while preparing the receipts and the payments account. Adjustable items are to be considered. Adjustable items are to be considered while preparing income and expenditure account. Next, last one, it restricts itself to cash transactions only. In receipts and the payments account, only cash transactions are recorded. There is no credit transactions. So here you see, not only cash transactions but other also recorded. Other means credit transactions. So okay, these are the differences between these two. So now you have clear cut idea about how to prepare, what are the items are to be considered while preparing receipts and the payments account, what are the items not to be considered in preparation of receipts and the payments account, where the same is to be followed in income and expenditure account also. So what is to be considered, what is not to be considered is most important. Then you can get a clear idea about these receipts and the payments account and income and expenditure account. Okay, so you see, okay, first let us know what are the features, non-profit organizations features. Voluntary association, this is not established by anyone, it is voluntary association. That means voluntarily members may came and establish the organizations. So they are separate legal entities. So sometimes the act may be implemented, or the government may establish this type of organizations, may continue. Okay. Next, non-profit organizations are formed for the welfare and service of the society. Yes. So earlier one organizations, that is profit motive organizations, means so they investors invest something and may expect something. So that is, they are expecting returns. They are taking risk. They are taking a risk and they are expecting returns. So that's why. Whereas in non-profit organization there is no investments, there is no expectations. So that's why non-profit organizations are established for welfare of the society. So they are set up as charitable trusts and clubs. So these are the organizations are established for charity and trustees. Okay. So next we see, they do not operate with the objective of earning profit. Earning profit. Yes, the profit may be, what we say, the profit is here, the profit is known as surplus, arising due to its activities, is used for promoting the objectives of for which they are formed. Yes, whatever the surplus, whatever the profit we have in non-profit organizations, that profit is used to spread the activities of the organization. Okay. These organizations are managed by a group of elected members or trustees. Yes, whatever the activities are there, that activities are to be performed by the elected members or group of the members, committee of the members. Okay, they do not undertake trading activities. Yes, definitely. So because this is not a trading organization, so that's why they don't take any trading activities, buying and selling activities for profit. So if this activity is to be done, then this type of organizations are not to be considered as non-profit organizations, because this they are expecting profit, and they are doing buying and selling of goods for profit. So that's why they these non-profit organizations are not to be uh, performed buying and selling of goods for the profit. So the organization itself established for service model. So that's why they don't expect any profit or any other things. Okay. In course of its activities, the organization may earn some profit. Of course, because of activities, the organization may earn something that is known as surplus. The surplus is not distributed among its members. Yes, whereas profit is earned by the trading organizations, those profit is to be distributed among the members. But here, of course, earned something profit, as we say, surplus, that is not to be distributed among the members. Okay, these organizations collect donations and contributions from the members and outsiders to meet the cost of work undertaken, and also to meet the operating cost. Yes. So these organizations collect donations and contributions from the members. So in this type of organizations, in three ways they may get funds. From members they may get subscriptions, from non-members they may get donations, from the governments they may get grants or contributions, something. So in these three ways, non-profit organizations may get funds. Funds raised from the members and the non-members and government or agencies. So these are the special features have to be considered in this type of organizations. Next one, particular items, special items. Special items have to be considered here. So you see legacy. So what is legacy? Legacy, the will of the donor. So the amount received by the concern according to the will of the donor. So the donor is willing to contribute something, willing to donate something. So that is to be received by the organization. So it appears on the debit side of receipts and payments account. It should not be treated as income unless specially instructed, but it should be treated as capital receipt. It should be credited capital fund account. Okay. So why it is treated as capital item? Why it is treated as capital item? So the donors is not ready to contribute regularly. This is not a repetitive in nature. This is non-repetitive in nature. So that's why it is considered as capital item, even though it is to be recorded on debit side of receipts and payments because of receipt, and whatever we receive, that is to be credited to capital fund, because this is included, this is to be added to capital fund. So that's why that is legacy. And donations are recorded on the debit side of the receipts and the payments account. Donations are usually treated as income because this is repetitive in nature. So rules of allocation may provide that the part of donations are to be treated as capital. Sometimes that may be treated as capital also. When donations are received for specific purpose, so you see here specific purpose. Specific purpose, that is treated as capital item. Specific purpose is treated as. So whenever we are collecting donations for specific purpose, for example, construction of building, construction of building, construction of dispensary, or whatever it is. So those are recorded as capital items, and repetitive in nature is treated as income. Okay. Right. Next one, subscriptions. Subscriptions appears on the receipt side, debit side of receipts. Subscriptions are given by the members of the organization, so that's why it is repetitive in nature. So that's why it is, if it is a regular item, it is treated as, if it is a regular item, this is recorded on, it is treated as income. Okay, you see, cash should be exercised in crediting subscriptions to the income and expenditure account. Only subscription relating to the period under consideration should be credited to income and expenditure account. Okay, so all the members are given subscriptions to the organization, so those are to be recorded here. Life membership. So throughout the life, membership will be collected from the members. So whatever it is recorded as receipt. It is, if it is membership considered for a term, that is life membership is considered for maybe 1 year, then it is repetitive in nature. Life membership is considered for throughout the life, this is considered capital items. So based on that, it is to be treated. Entrance fee. Sometimes the organizations may conduct activities, cultural programs, entertainment programs, or traditional activities to the society. Then they may get some earnings for that, for such type of activities. Entrance fee may be collected from the audience. So based on that, it may be treated as a revenue item and a capital item. So if it is repetitive in nature or non-repetitive in nature, that is to be considered here also. Sale of newspapers in the periodicals. This item appears in the receipts and the payments account because of receipt. Amount realized on newspapers, periodicals should be treated as income and therefore to be credited to income and expenditure account. Next one, sale of sports material. Yes, so sale of sports material, from where we get sports material? Clubs and societies, sports clubs and societies may get material, may purchase material and use it by its members, and later it may be treated as scrap. So that is to be disposed at once. So let us take example, sports material like balls, bats, mats, nets, etc. That is to be disposed one place, maybe a year, and maybe 5 years, maybe 6 months, according to the usage of the members, according to the purchase of the material. Okay, sale proceeds are to be treated as income. That income is to be recorded on income and expenditure account. Okay, last one, tournament fund. So tournaments are to be conducted by the organizations, non-profit organizations. So here tournament fund is maintained. All expenses relating to tournament should be deducted from the tournament fund, and the balance is to be shown on the liability side of the balance sheet. Under no circumstances, tournament expenses appear on the debit side of income and expenditure account when there is a fund for its purpose. Okay, this is the tournament fund. So in the next class, we will know how to prepare balance sheet and how to prepare how to prepare balance sheet and how to prepare this one. So last one. So with this we are going to move. With this we are going to move this. We are going to close this video lesson. Uh, thank you and bye.